The US and China are now locked in a full-scale tariff war, with Washington slapping a fresh round of duties on Chinese goods, pushing the total to a staggering 104% as of April 9th. In retaliation, Beijing responded with 84% tariffs on American imports. This major escalation follows earlier salvos, including a 34% US tariff linked to China's alleged role in fentanyl trafficking and a 20% duty that sparked China's first round of countermeasures. But this time, Beijing had made its stance clear: we will fight till the end.
If China's export 104% tariff would hurt it very severely. See, if some US citizen was buying something for $10, can you expect him to overnight start buying the same thing for $20? So what would happen? Chinese exports would be hit. Only and only the necessities would be purchased by the consumer if the prices increase within a week by more than 104%, by more than 100%. So that would definitely have a huge impact on Chinese exports.
On Friday, China had hit back with a 34% tariff on all US imports, introduced export controls on rare earth minerals, and rolled out several other measures in response to Trump's so-called Liberation Day tariffs. In retaliation, Trump slapped an additional 50% tariff on Chinese goods, declaring that all negotiations with Beijing were officially terminated. Official data shows the US trade deficit with China stood at $295.4 billion last year. Analysts warn that if Beijing escalates further, Trump's measures could severely impact China's exports to the US, its third largest trading partner after ASEAN and the EU. The Chinese Commerce Ministry has warned that China will firmly respond with countermeasures to protect its rights and interests if the US continues to escalate tariffs. The ripple effects of this tit-for-tat tariff war are already being felt across the globe as governments scramble to cushion their economies from the fallout of a clash between two economic superpowers. In a diplomatic move, China reached out to India for a joint stance against the US tariffs. But unlike Canada and China, New Delhi chose to steer clear of a direct confrontation with the Trump administration.
Now, tariffs against India are much lesser than tariffs against China. So there can be a lot of manufacturing which may shift to India, since India would get tariff arbitrage. Secondly, India stands to gain also from this situation because money which was meant initially for Indian stock markets, the global money, global portfolio money, it had started going to China. Now with China into all these problems and tariff war, global money wouldn't go to China because global money is primarily American money. So they would prefer coming to India, which is a friendly country, which is not involved in a trade war, which is negotiating.
Chinese exporters are adopting two key strategies to cushion the blow of the trade war: relocating parts of their production overseas and ramping up exports to non-US markets. With global supply chains hanging in the balance, pressure is mounting on Beijing to act decisively as President Xi Jinping kicks off a crucial tour of Southeast Asia.